Thank you very much. I have lots of stuff for you. There'll be a lot of slides. We'll go through them pretty quickly. Most of the charts will have a dotted line in them, which shows you the current reading from the data. NFIB has 350,000 member firms nationwide, probably NFIB members here in the congregation, I hope. And we survey them now every month. We take a random sample and collect data on how well they're doing. I'm going to show you a lot of that information. October is the 40th year that we've done this, so we really have established a good track record on being able to look at how the small business sector is doing. So I'll be going fairly quickly through these. You don't have to look at details. You'll see an image and you'll see where we are, where we've been, what we should look like, and get an idea of what's happening with the economy. All right, a quick look here. See kind of the trouble that we're in now. The blue line is gross domestic product. Everybody knows what that is, right? It's the total value of everything we produce in a given period of time. So usually we talk about it at annual rates. So you can see the blue line. You can see the blue line peaks in 2007, and then we have the recession. And now you can see we're making much more output today than we did at the peak in 07. So we're making a lot more stuff. The red line is employment. It also peaks, in 2007, late in 07, and kind of hangs in there through early 2008. Then employment goes down, and notice that it has recovered, but not to where it was in 2007. So we're making much more stuff today than we did in 2007, using 2 million fewer workers today than we had then, and that's one of the problems we have. Now, this is why I think a lot of that unemployment is still with us. The housing sector, very, very labor intensive. You've seen things built. There are always people crawling all over it. Very labor intensive business. We were doing as many as 2.2 million starts late in 06 in the crazy housing bubble. It crashed all the way down to 500,000. We're moving back to around 900,000 at an annual rate now, but long term, we really need to have many more starts than that. So we're really missing hundreds of thousands of single family and multifamily housing starts in the GDP numbers, right? So that would make it smaller, but most importantly, that's where the unemployment problem really is. So you can see home ownership rates have really declined substantially. Barney Frank wanted everybody to get into affordable housing. He was unable to accomplish that, so he put lots of us into unaffordable housing, and now we're making that adjustment. So obviously we have more renters now and fewer homeowners, and that's one of the things we're trying to sort out. You can see here the share of this GDP, gross domestic product, which is identically equal to our income, right? If you have a little company and you're making widgets and you're selling widgets, the way we measure gross domestic product is we look at your cash register tape. How many widgets did you sell? And we adjust for the prices. So we're looking at how many you produced, but your income was identically equal to that output. So P times Q, price times quantity, that's GDP, but it's identical to your income, and that's the way we measure GDP two ways on the income side. So this is the share of that GDP that we consume. Our consumption spending is everything that we do except buying a new house. We count that as an investment, an asset that gives you returns for 30 years, unless it's in Florida or Galveston or somewhere like that. Could be a little shorter. You can see around 2000 we started partying, so more and more of our output was in consumption, and it went up and up and up and up. All right, which means we were saving less and less and less. In very simple terms, if you don't save in an economy, you can't invest, right? Because if you don't put money in my bank, I'm the chairman of a little bank in New Jersey. If you don't put money in my bank, I can't make loans to small businesses to expand and buy equipment and hire people. It can't happen. So for an economy, that's always the case. You can't invest in new equipment and growth more than you save. And of course, the United States is a lousy saver, but we borrow the rest of the world's savings, and that's how we kind of get along. Well, you can see the savings rate, that's the red line. The red line is our savings rate out of our disposable income. In the olden days, it was 10, 12%, which wasn't great. We estimate it's around 40% in China, for example. So 10 or 12 wasn't great, but we took it all the way down to 1% in the fourth quarter of 08, and then Lehman and Bear Stearns happened, and they're interviewing all over CNBC this morning about that. So it crashed, and you and I said, gee, maybe we should save some more money. So we did. We took the savings rate from 1% down there up to around 6%. So that's still 6% is nothing to write home about. But it was a big increase, and here's the problem. Every percentage point in the savings rate is $100 billion of your spending, $100 billion. So in one quarter, you and I cut our spending at an annual rate for $500 billion, $500 billion. Now you see the savings rate's going down a little bit again. It's not very good, but of course, as you'll see, we don't have a lot of demand for money, so that's not necessarily a problem. The other thing we did was to borrow lots of money. This is from the Fed's flow of funds accounts. The green line is our total indebtedness, including tricky forms of debt, like leases. That's really a debt. We count all that as debt. You can see suddenly, again, around 2000, we started taking it up all the way up to $14 trillion. It's starting to taper down a little bit now. But my academic exercise was to say, suppose we took our debt-to-income ratio in 1999 and we kept it, you and I kept it there as GDP grew for the last 13 years. What would our debt look like? And that's the red line. And you can see we really partied away here, borrowed lots and lots of money, way off trend. There's always more debt because we have 3 million more people in our economy every year, which is good as part of our growth. But we really put a lot of debt on the books, and that's one of our problems. So here's the Michigan Index of Consumer Sentiment. I did that for 5 years when I was at the University of Michigan. And I just want you to see the current reading is very bad compared to where we should be. The all-time high was in 2000, of course, the best economy in history in many perspectives. But you can see consumer sentiment's really been in the tank, so to speak, for years now, because each one of those dots, except the blue dot, which is the most recent reading that we just got for September, not good. All right, so if consumers aren't optimistic about the future, they're not going to spend. If they're not going to spend, we're not going to hire, right? You know how that goes. This is the percent of the people in the Michigan survey who think government policy is good. Now, you can look at that and you can see that it's just been trending down and down and down. We're not very satisfied. We don't have a lot of confidence in government. The red dots are the current administration. And you can see we still don't really believe very much in the fact that the government can solve our problems. So only about 1 in 10 consumers think that government policy is good today, and around half say bad, and then the difference is the people who say it's fair. So I'd like to meet the 1 in 10 who think it's good, but I could probably figure out who those are. But anyway, obviously consumers don't think that we're going to get out of trouble by letting Washington deal with the issues, and that's unfortunate for confidence going forward. So just a few facts about small businesses, which we'll talk about now. 90% of all the employers have fewer than 20 employees here in the United States. 99% have fewer than 500. That's the SBA's definition of what a small business is, and they produce about half of the GDP that we talked about, and employ a little over half of the private sector workforce, and create about 2/3 of the new jobs. That may seem contradictory to you, but what I'll point out is that we fail a lot. All right, so Bill Gates wasn't the only guy who was trying to do an operating system for computers. Right, there were lots of other people trying to do the same thing. He won the competition. But in the meantime, all the other people who were out there employed tens of millions of people, gave them experience, et cetera, et cetera, et cetera, helped train the workforce. The small business sector is the R&D for the economy. That's where we try out our new ideas, our new ways to do things, our new strategies, our new products. We try it out there. If we're right about it, if we're good managers and the idea is very good, we make money and we use that money to grow our business. And of course, that attracts copycats, which we don't like, but we like it from a macro point of view. That's good for us. And if we fail, well, we fail, but we don't lose the assets from society's point of view. We have the people, we have the building, we have all that stuff. We just reprice those assets and start another experiment until somebody makes money. That's the signal in our system that you're doing something good, valuable with the resources that we're using. So we just generate a lot of jobs for a lot of people all the time. It's a very dynamic process, as you'll see a few more charts on that. So here's my Small Business Optimism Index, which I did start 40 years ago in October. So my October survey is now in the field. And again, you see the dotted line through the current reading, which I'll keep a secret. I'm not going to release this until next Tuesday morning on CNBC. So you didn't see this. Keep that in mind. But it's not very interesting. It didn't change from last month by only 1/10 of a point or something like that. So the point you can see here is that we're in the tank here. Small business optimism is nowhere near where it should be. And it's been there for years. Each red dot there is a quarterly number. And then, of course, the little blue dots are the August and September numbers. And then October, I'll have a new quarterly number. For us, quarterly is January. We do big surveys, January, April, July, and October. So you can see our small business owners are not happy. How about business conditions 6 months from now? Do you think the economy will be better or worse than it is today? Look at those numbers. Obviously, we don't think that the economy is getting much better. And of course, if you don't think the economy is getting better, you're not going to hire, you're not going to expand your business, you're not going to do all those things. And speaking of expansion, is now a good time to expand your business substantially? Well, the answer's been no for 23 quarters now. Look at where we should be, and we're not there, all right? And that's why we're not doing very well. So my kind of thesis about what's happening in the economy is that we're a bifurcated economy. You've noticed the stock market's at record high levels. You know that corporate profits as a share of GDP have been at record high levels. All that looks really good. But yet the GDP growth rate's 1.8%, and it should be 3 or better than 3. 3 is our trend growth. And the reason, in my mind, is simply that the big firms are doing very well. Most of their sales, over 50% for the most part, are overseas. They have overseas markets and so on. They're doing well. But the other half of the economy, small businesses, are not doing well at all. So if they're growing at 4% and we're growing at 0%, 0 plus 4 divided by 2 is 2, and that's been basically our trend growth rate since the recovery started in 2009. So you can see the problem we have here. Those who said it was a bad time to expand, that was about 65% said no, it's a bad time, and the others are uncertain. Only 7% said it was a good time. You can see that one of the most common reason they give, of course, is the economy's weak, sales are weak, et cetera. But you can see that over 30% said it's a bad time to expand because of the political environment. If we could just fix that, we'd probably start to move ahead. You can see what happened when you and I stopped spending. Look at the quarter-on-quarter changes in sales. You and I took this economy down in the fourth quarter of 2008 and the first quarter of 2009. We consumers, and of course it's been a tough road to get back. Our profits look the same way. They follow that same track. How about looking forward? Do you think your real sales will be higher or lower in the next 3 months than they are today? Well, those numbers, again, you look and you see that, it's a positive number, but historically it's very weak, especially for a recovery period. We thought we were going to recover like we did in 1983. In the first year of that recovery from the 80-82 period, GDP grew 8% at an annual rate, 8% for the year. And we haven't come anywhere close to half of that in this recovery. Here's the employment numbers. You can just get a quick look, and I'll just highlight a few of them. The green line, of course, was the housing construction. You can see the peak and then go back down. The red line, of course, is employment in manufacturing. It continues to decline because productivity is so high there. Manufacturing output is growing. In fact, that's how we filled the gap in GDP. GDP is higher today because manufacturing output is huge, but we make more cars and more tractors and so on with Caterpillar without using a lot more workers. And so even though we have all this output that filled the hole made by the housing industry, it didn't generate a lot of jobs, and that's the problem that we have. So manufacturing and employment will probably continue to trend down just because productivity is so high. The purple line on the top, of course, is government employment, and you can just see from that they usually don't notice there's a recession, although it did tippy down right there at the end a little bit, but not a lot going on. I was talking about the dynamics of our sector. Look at this. This is births and deaths. It takes a long time to get these data. So they come in with a lag. So the latest data here is about mid-2012. But you can see that during the boom, not only did we build too many houses, we built too many strip malls and little restaurants and new retail outlets and so on. Small businesses starting everywhere. That's the green line. And of course, terminations were pretty low. And then, of course, the recession hits and terminations skyrocket and starts fall way off. And now we're back at a point now where we have more new starts than we have losses. That it's good for job creation, but you can see what a dynamic that is. And it's such an important dynamic. Countries that don't have that dynamic, of course, don't do as well as we do. Average change in employment per firm. Guess who fired the 8 million people during the recession? It wasn't GE. GE only employs 150,000 people in the U.S. And we fired 8 million people in the recession period. There we are. And, we're struggling to get back, but obviously there's not a lot of job generation per firm going on there. The blue line is the percent of firms who said, I reduced employment in the last 3 months. And you can see it peak. Now it's way down kind of to normal levels, which is why this morning we got a very good initial claims for unemployment number, 300,000. I know that sounds like a lot. 300,000 a week times 4 is 1.2 million a month that we fire, but you'll get 100,000 or more jobs this Friday. If we get an announcement, we might not because the government's not working. But if we got 100,000 net new jobs this Friday in the numbers, that would mean that we fired 1.2 million and hired 1.3 million, and that's the dynamic of our labor force. So the unemployment or the initial claims numbers are low because we've stopped firing people. But we haven't, the red line, we haven't started hiring them. And so that's what we really need to have happen. Unfilled job openings, oops, my dotted line's in the wrong spot. So imagine the dotted line is a little bit higher, goes through the blue dots. Again, you can see it's pretty weak compared to historical recoveries. We don't have a lot of job openings. Why? Because we don't have customers and we don't have a need to hire. Do you plan to increase or decrease the total number of people working for you? Well, again, you can see that we've been improving, of course, from the recession level. That's good. This is job creation, but it's still pretty anemic compared to what we would expect historically. So we're struggling to get back. The economy is growing. 3 million more people every year means 3 million more haircuts. Like it or not an exciting thing, but that's more barbershops, more employment, just because we get 3 million new people every year. They live somewhere, helps housing. You get the picture on that. Here's our capital spending. See how I'm doing there. You can see again that the reports of actual capital expenditures are pretty low. They've improved from the recession period, but they're still historically very low. Capital spending is really important. That's the way we raise worker productivity. If we don't have new capital, then we can't pay more to the workers because we can only pay you the value that you produce, and capital is really important. So this is planned capital outlays. Again, you can see that historically, the numbers are pretty anemic. We're kind of in maintenance mode. If the roof leaks, we'll fix it. If the equipment breaks down, we'll actually buy new equipment, but we're not really expanding the business and we don't plan on making any outlays. So I put this in to illustrate that. How much could you pay one of these guys per hour? I talk fast, don't I? But, time limit. How much could you pay one of these guys per hour? And the answer is not very much, because with the capital equipment they have, a shovel, they can't move very much snow. But what if one of these people came in and to my bank and got a loan and bought a snow plow? That person could move a lot of snow per hour and could earn a lot of money per hour, right? And that would free up all these people, of course, to do something else useful, like take over another country. But the point is, this is the dynamic that's missing. And if we're not investing, in the future, then real incomes can't grow, productivity can't go higher, which is what we really need to keep things moving along. You can see the change in inventory quarter on quarter, so we'd ask them if their inventories are higher or lower. When you stop spending, when you and I stopped spending, we had to get rid of inventory, right? Boom. And that's a huge, huge adjustment, as you can see. Well, that was my thing. There we go. And then we're asking now, do you plan to add to inventories? They're saying, well, no. Why? Well, again, we don't have the customers coming in, so I don't need to add to inventories because I don't have anybody there. Here's how we got rid of the inventories. This is the percent of our owners who say they raise their average selling prices. So I draw your attention first to the far left, the pre-1983 period. Most of you look like you're too young to remember that, but that was serious inflation, right? And you can see as many as 70% of our owners are raising prices. Then Volcker comes in, we have the 1980-82 recessions back to back, and you can see we get what you might call price stability. The fun thing is then the next spike is the first quarter of 1980, the first quarter of 2008. There we go. That's when we had serious energy cost problems and everybody's raising prices. All of our firms are raising prices to pass those energy costs on to you. That's the peak. 4 quarters later, of course, is when the economy falls out of bed in the fourth quarter, when you and I cut our spending. And of course, what you see there is that we dramatically had to start price cutting in order to get this inventory moved out, try to turn it into cash. keep the business alive if we could through this recession until we recover. So now we're down, you see about as many owners are raising prices as cutting prices. So we have kind of a net 0 or net 1% raising prices. No pressure, the Fed's right, there's no pressure on prices, there's no inflation in the cards there, but it could happen, if things change. This is always I don't translate this is for you to translate. This is this is one of our wild cards, is that energy prices again. We'll have to see what happens there. You're kind of in the area where this is all exciting kinds of stuff that's stripped from Texas all the way up to the Canadian border. We can be self-sufficient energy-wise maybe in a decade or so, meaning not that energy's cheap, but that we could buy it all kind of in North America, all right, whatever we wanted to get. That would be handy-dandy. Of course, we do have very cheap natural gas now. It's about $3 a unit in the United States and $13 in Europe. And the simple reason is, anybody want to guess, why is that the case? Why is it $3 here and $13 there? We can't export it. Oil is one price, right? You can move oil around in those big tankers all around the world, so it's a world market. But we cannot export natural gas right now. All right. We do have a couple of LNG plants that the government thought we should build 10, 15 years ago, thinking because the government said we were going to run out of natural gas, so we built them. Now we're converting them to export plants, and we'll make other ones. So over the next 10 years, we will export natural gas, and the prices will equalize in the markets just as it has for oil. But for now, we have this wonderful cheap natural gas that's bringing companies here who manufacture and use hydrocarbons as inputs. It's really kind of a cool deal. So a lot of it will just depend on what kind of energy policy we get. This is still a controversy, as you know, so we'll have to see whether it gets approved or not. We'll move along. It says coal is threatening the planet. Well, it probably is. It's like 60% of our CO2. But anyway, those are the things we have to worry about. So what are the most important problems facing small business? You can see it varies. We give 10 choices all the time, and watching my time here. You can see that the green line was poor sales. That was it for a while. But now it's really kind of a tie in like around 20% between taxes, regulation and red tape, and weak sales. So weak sales went all the way down to 16 in September. So it's starting to leave the critical map. But longer term, we do a study every 4 years and give people like you 75 things to rank from high to low in terms of what's the worst problem you face. Rising healthcare costs. That's been number one for 25 years. You go back more than 25 years, it's interest rates and credit. That's back in Volcker's time. Uncertainty about the economy is 2. Energy costs, number 3. Uncertainty about economic policy, like what are my tax rates going to be, for example, or how much will a worker cost me under current healthcare law. The cost of regulations and red tape, and then 6, 7, and 8 are all taxes. And I just put the other 2 in to show you that the kinds of things you thought small business owners would worry about, they do worry about, but look what dominates the list up here. So quickly turning to what's been going on with the financial markets. It's fun and games. We'll have to see what happens now as we go through this trial period. But Ben to the rescue, there he is. That's why we call him Helicopter Ben. He's done a good job of that. So these are 2 complicated looking charts. I just will call quickly to your attention the size of the Fed's portfolio before the crisis was just under $1 trillion. That's to the far left. Then the crisis happens and all the special programs, TARP and everything comes in, and then they kind of wound their way down. Now you can see the Fed has taken its portfolio from $1 trillion to, I should update this a little more, $4 trillion now in the Fed's portfolio. And you can see basically it consists of just treasuries and mortgages, and the Fed, of course, is buying mortgage bonds to try to keep mortgage rates low. That's fine. Here's the liability side. Currency is the big piece, and excess reserves. Now, I just want to point out again, before the crisis, banks had excess reserves of $13 billion. Sounds like a big number, but relatively, it's like nothing. You didn't keep money in excess reserves because you couldn't earn anything on it. We only get 25 basis points on excess reserves. Today, excess reserves are $2.2 trillion. Now, a quick lesson, what's an excess reserve? here's quantitative easing. The Fed comes to you and says, let me buy that bond you have, and they give you $1,000 for the bond. You make the deal. They take the bond, they put it in the asset side, they have the bond, and the liability is to you. You take the check, put it in my bank. I have to keep 10% of it as required reserves, so that's 100. But the other 900 I can lend out. But the problem is nobody wants the money, so that's why we have over $2 trillion in excess reserves sitting there. Banks could lend that out if they could find somebody to lend it to. Well, you can see from our point of view, we had some trouble this time, but nothing like we had back in the pre-1983 period. This is the percent who say, last time I got a loan, it was harder to get. This is the percent who are borrowing on a regular basis. You can see that has trended down dramatically. It was highest when the prime was at 21, and now it's the lowest when the prime is about as low as we can get the prime. Another question we ask is, were you able to get all of your credit needs satisfied? 30% said yes, 6% said no, and 54% said, oh, it didn't update that chart, shame on me. Anyway, 54% in September said, who wants a loan? And if you add the 13% who didn't answer the question, assume they didn't want a loan, that's like 2/3 of our members for a long time now have said, what do I do with the money? Where do I put the money where I can get a return which will allow me to pay the loan back? That's the whole idea. And I think the future looks terrible, and I don't have customers, so I'm not borrowing money. So all the people that I would like to lend to at my little bank are sitting on the sidelines waiting for something to happen. So what is the most important problem? Back on that chart, here's some more of it. You can see inflation is the all-time winner, and then credit was during the Volcker period, but you can't see in that blue line where the credit crunch happened in 2008, right? It's not there. On Main Street, it didn't happen. Credit availability wasn't an issue for the small business sector in general. You can see the spike in inflation for 2008 first quarter, right, when we thought we were in real trouble there. This just shows you what's been going on with C&I lending. You can see for small businesses, our share has been going down in the recovery, and of course the number of loans under $1 million has been going down as well. So total C&I lending is up, but it's the big firms that are borrowing the money. Our share is declining. Our actual number of small loans has been declining. So we really haven't been going back and asking for the money yet. So, God, I made it to the end. So this is where we are today. I said GDP, we expect GDP growth to be about 1.8 for the year. We had 2.5 last quarter, but of course that was preceded by some terrible quarters. So we'll have to kind of see where it goes at. It's tracking now at about 1.718. Obviously, this government shutdown will hurt the GDP numbers just mathematically because we measure government's output, which is 20% of GDP, as just the value of wages that they pay. So we assume that we got a value equal to the wage we pay the government workers. Well, if you lay off 800,000, which they aren't doing, of course, that many, ultimately maybe they could, but the point is that government salaries are not happening now, and if the more of that happens, the lower the GDP measure will be because we assume they're not producing anything, and so we don't count that. So it'll be a mathematical thing. Of course, when we get a budget, they'll get back pay, et cetera. But you could, if it lasts long enough, it could affect the numbers on a quarterly basis, but otherwise not much trouble. So look for 2% growth, very, very weak growth. Unemployment rate's high. It's going to be stuck there. The main reason the unemployment rate has declined in recent year or two is not because we've created more jobs, but because people have left the labor force. The participation rate, that is the number of people who have a job or are looking for a job, has crashed. And that's the main reason the unemployment rate is coming down. So we want it to come down because we're creating jobs, not because people are giving up. See where that goes. Obviously, interest rates are going to remain low for the rest of the year. The Fed is committed to really making that happen. We're not sure if they're going to, they'll have to taper because they can't keep buying $1 trillion more per year of securities and adding it to that portfolio you looked at. So it's not, the question is really when will that happen? So one of the things I think you can expect is that the president will get out of this, all these deals, is that taxes are going to go up. Certainly they go up in the health care bill, and that's there. But he's looking for other taxes too. He said he'd cut corporate tax rates. Most small businesses aren't incorporated, by the way. He said he'd cut corporate tax rates, but only if it ended up yielding more revenue. That's his deal, so that's what he was looking for. I like this. He says, 4 years in college and I get a job flipping burgers for minimum wage, and his buddy says, quit bragging. It's tough out there for young people. I have a 26-year-old son who just graduated, and he did get a job, thank goodness. And we moved him out last week. A family formation, that helps out on this. I just want to show you this, though. There's, of course, they're talking about raising the minimum wage to $9, $10, $11, $12. There are all these proposals. That's just a plot of the minimum wage and the percent of teens who are in the labor force, either working or looking for a job. And now part of that is that more of them go to college, so it delays it a little bit. But you get the idea. If we make it too expensive for a small business to hire somebody, then they'll never get the training that they need. They'll never become part of the labor force, and that's really sad. In the long run, I am very optimistic about the economy because of you, because of the private sector, because of your entrepreneurial spirit, your innovativeness, all those things that made this country great will still prevail. Even though more obstacles get put in our way, we'll triumph and we'll get this economy back and running again in spite of the roadblocks that are put up. So thank you all very much. Thanks for coming to the conference.